Now, this is part 2 of session 1 lecture. In this introduction, we will be talking about different types of financial markets. In the last part, we briefly talked about the role of financial markets. Now here, we will be talking about different types of financial markets. First of all, primary markets versus secondary markets. Primary markets are the marketplace where newly issued securities are traded. So a firm sells new stocks or new bonds. So that is the primary market. So firms raise new capital in the primary market. GM sold common stock some months ago to raise new capital. That is a transaction in the primary market. There are two types of primary market transactions. One is IPO. The second is seasoned offering. IPO is initial public offering. A firm goes to the public for the first time. That is initial public offering. And once the firm has sold shares before, now firm is going to the market again to raise additional capital. That is called a seasoned offering. Usually when a firm starts, a firm raises capital from private sources. Usually the owner contributes some capital, and then they go for the angels and venture capitalists. So these are all private financing. But once the firm becomes bigger and the firm runs out of all the private sources of capital, then they may go to the public to raise the greater amount of capital. That is how IPO starts. IPOs are known for initial under pricing. That means during the first few days of IPOs, typically prices go up dramatically, but eventually it is known also that IPO prices, IPO shares do not generate any abnormal returns compared to non-IPO shares. So that is the primary markets. Primary markets are a marketplace where newly issued securities, not only firms, but also government sells new securities to borrow. So treasury securities are sold periodically every week, every month, and every quarter. So these are also transactions in the primary markets. Compared to the primary markets, we have secondary markets. Secondary markets are the marketplaces for the existing securities. Already issued securities are traded in the secondary markets. So on the New York Stock Exchange, they sell IBM shares. In that case, Mr. A buys shares from Mr. B. That is a transaction in the secondary markets. In that transaction, IBM is not raising any new capital. Just in this situation, the ownership changes from A to Mr. B. Okay, so firms do not raise any extra capital in the secondary markets. But secondary markets are important because they provide liquidity. So even though the secondary markets not contribute to the productive capacity of the economy, they do so indirectly by providing liquidity to the individuals who buy these securities. As I mentioned before, since we do have the liquidity in the secondary market, investors would like to pay the full price. As I mentioned, if you think the value of the stock is $100, but the market is not liquid, that means you cannot sell these shares when you need cash. So knowing that, you don't want to pay the full price of $100, maybe only $95 or $90, depending on the liquidity. Right? But we do have a very liquid market like a New York Stock Exchange and NASDAQ and things like that. So investors would like to pay the full price. That means firms can generate the capital at the cheapest cost. There are different types of secondary markets. One is the exchanges. Exchanges are the physical places where they get together to buy and sell securities. New York Stock Exchange is a typical example. And for the options, we have Chicago Options Board of Option Exchange. That is another physical place. And for the commodities and futures, we do have Chicago Mercantile Exchange and New York Mercantile Exchange. These are exchanges, physical places where they get to. Even though these exchanges do have online transactions as well. So these are usually these days hybrid markets. But exchanges are basically physical places where they get together to buy and sell securities. Compared to the over-the-counter market is not a physical place, not a physical exchange. As long as you have a dealer for a certain security, you have an over-the-counter market. Okay, many securities are traded on the over-the-counter market. Smaller company stocks are traded on the over-the-counter market. NASDAQ used to be a type of over-the-counter market, but some years ago it changed into an exchange. Even though NASDAQ does not have any physical place, it is an online exchange. So they are now called an exchange, even though they do not have any physical place, since it is an cyber exchange. For that matter, we do have a lot of online auction system called ECN, Electronic Communication Network. It is an online version of the exchange. So it's a computerized trading network, which is known for its cheaper transaction costs. Actually, New York Stock Exchange purchased one big ECN some years ago, and NASDAQ also purchased some ECNs some years ago. So nowadays, there is no clear distinction among exchanges and ECN, because exchanges do own ECN, and then they do have a kind of a hybrid market. Okay, so first, it is important to know the difference between primary versus secondary market. In the true-false question, New York Stock Exchange is an example of secondary market. That is true. Right? Now let's move on to the next slide, where we have the distinction between spot and forward or futures markets. To understand the difference, let's take a simple example of a farmer and miller. And farmer is going to have a new harvest of wheat pretty soon, next week or so. And the miller needs to buy wheat pretty soon, so they can make a transaction. That is a typical transaction in the spot market. You don't have to even say the spot. The spot market means on the spot. So delivery will be made a few days later, and then the miller is going to send a check in a few days. So that is a typical spot transaction, a spot market transaction. Compared to that, suppose farmer is going to have a new harvest of wheat 6 months from today, and miller is going to need to buy some amount of wheat 6 months from today. Now, farmer is worried about the situation where the price of wheat goes down in 6 months. Suppose every farmer is bringing his or her new harvest of wheat in 6 months to the market. Temporarily, there will be excessive supply of wheat, and then price of wheat may go down. Farmer doesn't like that. So farmer would like to make a transaction now to sell certain amount of wheat at a certain price. In the other side of the transaction, take the miller. Miller is worried about the case that price of wheat in 6 months may go up. In that case, miller has to pay higher prices. So miller would like to make a contract as of now to buy wheat at a certain price 6 months from today. That is a typical forward contract. Forward contract, basically the difference is the time of delivery. In the forward market, the time of delivery is not until sometime later. And also cash will not be paid until sometime later. So time of delivery is what makes the difference between spot and forward market. So that is pretty straightforward. So we make a contract now, no money is traded, no goods are traded now, but 6 months later, shipment will be delivered and the money will be paid by the miller. Okay? So farmer's position is called a short position, which is a commitment to sell. And miller's position is called a long, is a commitment to buy. Short means selling, long means buying. Okay? Let's take another example. Suppose we have an investor who invested 10 million Japanese yen in Japanese bonds like 9.5 years ago. So 9.5 years ago, this investor bought a bond from a Japanese company which is denominated in Japanese yen. And original maturity was 10 years. So 6 months from today, this investor is going to get 10 million Japanese yen from Japanese company. So they're going to pay it back to this investor. Then this investor has to change this 10 million yen into US dollars because this investor is living in the United States. So this investor is going to sell Japanese yen 6 months from today. If the value of Japanese yen at that time goes down, this investor would lose as a result of that. So this investor would like to make a commitment to sell Japanese yen, 10 million Japanese yen, 6 months from today. That is exactly same as the farmer's position, which is a short position. So this investor would like to have a short position in the forward contract in the Japanese yen forward contract. The other side of the contract could be a firm which needs to pay 10 million Japanese yen to a Japanese company in 6 months. Suppose this company purchased a machine from a Japanese company, and according to the contract, 10 million Japanese yen has to be paid 6 months from today. At that time, if the Japanese yen value goes up, this investor may have to pay more dollars. So this firm is worried about the case that Japanese yen value goes up, as in the case of Miller. This firm can have a long position in the Japanese yen forward contract. So this investor makes a contract to buy Japanese yen 6 months from today. So long position. So you can understand underlying assets are different. In case of this Farmer and Miller situation, it was the wheat. In case of this investor and firm, the underlying asset is Japanese yen. As long as there is price uncertainty, investors would like to have some insurance against the fluctuations. So that is why they have introduced forward. Most of the forward contracts were about on the commodities like wheat price, corn price, butter price, lumber price, copper price, gold price, orange juice price, pork belly price, all these commodities until 1960s and 70s when they introduced newer types of forward and futures. Of course, we have had these a long time ago, but they were not very popular. But they had to introduce more forward and futures on financial instruments such as Japanese yen, euro, and interest rates, and index numbers, and things like that. Okay, so know the difference between spot and forward is the time of delivery. The main difference is the time of delivery. Then what is the futures market? How is it different from forward market? They're pretty much the same things. But remember, in the case of Farmer and Miller, and also in the case of this farmer and investor, they have to basically trust each other. Once the contract is made, we have to trust each other. But in reality, it's not easy to trust each other. And what if a farmer just goes away without honoring the contract? How about the miller? So there's some possibility. That's what happened many, many years ago. So they realized that they could not check the creditworthiness of the counterpart. So they introduced the futures market, where the exchanges or the clearing corporation guarantees all the transactions be honored. So a farmer has to deal with the clearing corporation, and Miller has to deal with a clearing corporation. In the middle of every transaction, there is a clearing corporation in the futures case. The farmer makes a contract with a clearing corporation, and Miller also makes a contract with a clearing corporation. This investor is making a contract with a clearing corporation. This firm is making the contract with a clearing corporation. Clearing corporation is making sure all the contracts are honored. So to do this intermediation, they had to standardize all the transactions. So in between farmer and miller, they can have any contract, 55,000 bushels or 57,000 bushels. But if once everything is standardized, they have to. Once it is traded by the exchanges, they have to standardize all the transactions. One contract of wheat with futures is 5,000 bushels. One contract of Japanese yen futures is for, say, 125,000 Japanese yen, something like that. They have to standardize. If you go to their website, see Chicago Mercantile Exchange.com, you can see all the contract specifications. Another difference between forward and futures is that every day the contracts are settled in case of futures. Now, in case of futures, the clearing corporations are stepping in and then just making sure that all the contracts are honored. So the clearing corporation is making a contract with farmer, and clearing corporation making contract with miller. Every time they make contract with any short position or long position, they want them to deposit certain money at the beginning to make sure that they have enough money in their account. So that amount is called a margin account. That account is called a margin account. So there is a safety bond deposit. So every day, the clearing corporation checks the amount of money in that margin account. And if they do not have enough money, they will call you to ask you to deposit more money, or they will cancel your account. So that is called a daily settlement or marking to market. Of course, they do not close your account and open account again, but they do as if they close and open it again. So mark to market. So every day they clear and then they reset the account. So by doing so, they check whether you have enough money in your account. Okay, so futures and forwards are pretty much the same, but futures are standardized version of the forward. In that case, the clearing corporation would like to standardize every contract, and also they like to mark to market their accounts. So you can understand many new derivative securities, futures and options and swaps introduced in the last 4 years can be seen as risk management tools for new era of increased volatility. Up until 60s, majority of the futures were on commodities. But starting in 60s and 70s, interest rate futures and options, and index futures and options, and foreign exchange rate options and futures, all these things became very popular because many firms needed some type of insurance. That means risk management tools for different types of price uncertainties. Now the next page has a taxonomy of different types of markets, just briefly. Money markets, bond markets, stock market, equity market, and derivative markets. So these are different types of markets. You should be able to see that. Money market means a short-term debt securities market. So if you like to invest, then these are very liquid markets. You can easily change all these securities into cash. And bond market is a long-term debt securities. Equity market is common stock and preferred stock markets. Derivatives market include options and futures and swaps. Okay. So this is the end of first session lecture, and participate in the discussion board, and we'll continue with the next session.